Alright guys, I was asked last week by a few students to go over a few practice questions over the material from last week. So in the words of Allen Iverson from the Philadelphia 76ers, today we're going to be talking about practice. So if I give you a sample income statement, can you identify a simple question like what is the gross profit margin for a business? So again, gross profit margin was an accounting ratio that we used. Now what did we use to calculate gross profit margin? Well, here's a hint. In the income statement, there's an item called gross profit. Okay, so we know that gross profit's $200,000. So what is that? What's that ratio for this business? Well, the definition I gave you for gross profit margin was gross profit divided by total revenue. Or 200K in this case divided by 50K would equal 0.4 or 40% would be acceptable answers. If I give you a partial balance sheet, and so here's assets, gives you cash, accounts receivable, inventory, total assets, or total current assets, property, plant, and equipment, goodwill, and a total assets of $1 million. If I ask you a conceptual question, it's simply like this. Again, you see all these things and you might start getting distracted, but I'm asking you a conceptual question. What asset is used to pay for an operational expense like wages? Alright, give you a minute to think about it. So if I'm asking what asset, you've got all these different things to choose from: cash, accounts receivable, inventory, PP&E, goodwill. What are you going to select? Cash. Or cash is what you've got in the bank, whereas accounts receivable is something you haven't received yet. Inventory, you'd have to liquidate it to cash to pay your wages. Now, if I ask you a true-false question like investing in more PP&E increases a company's liquidity, what would you say? So what's PP&E? So remember the property, plant, and equipment. $500,000 here. One, does this impact your liquidity? Think about that. What is liquidity? So liquidity is essentially how quickly something can get to cash. Well, cash is the most liquid. Accounts receivable is pretty liquid. You still have to get the checks in before they're cash, but we still like to count cash and accounts receivable when we do our liquidity equations. What about inventory? Inventory's tough. It's not as long term as say like a building, but it wouldn't really be part of our quick ratio if we're really wanting to find out how liquid a company is. But it's kind of in a continuum, right? So all the way down to your property, plant, and equipment, and goodwill, things that are a lot harder to sell, are less liquid. So investing in more PP&E means you've got to actually take cash to buy a car, or to buy a machine, or to buy a building. And so you're actually getting rid of cash to add to property, plant, and equipment. So the answer here is false. It's actually going to decrease your company's liquidity. Now if I give you a more solid balance sheet that has your assets, liabilities, and I leave a little space blank on equity, and I say, what's this business? What is the total equity of this business? So you got to remember our accounting equation that assets equal our liabilities plus our equity, or rewritten assets minus liabilities equal equity. So 1 million minus 400,000 would be 600,000. And what if I ask you what's the current ratio for this business? Now you'd have to remember current ratio. So the current ratio is an easy way to remember is current and current. So what are our total current assets divided by our total current liabilities? So in this case, we've got 300K divided by 100K equals 3. And last but not least, what is the quick ratio? So the quick ratio is something that we use to determine liquidity. And so in this case, we're going to take our cash plus our receivables divided by our current liabilities. So we want to know in these two categories, these more liquid assets, if we had to sell or use these to pay off our current debt, our current liabilities, I should say, current debts. For again, not talking about the long-term debt. So why is that a big deal? Well, your long-term debt is typically matched up with other long-term assets. So like long-term debt may be a loan that you took to buy a building, or to purchase plant and equipment, or different machines or whatever to build out your business. Your current liabilities are like your wages and other bills to operate the business. This is a quick ratio, well, it is a quick ratio, but it's really to look at how liquid the business is. Can you, right as of tomorrow, if you had to, would you be able to take your assets and pay off your most current debts, I guess? And so in this case, this current or quick ratio would be 1. So ideally, we'd want this to be a much larger. We'd love this to be greater than 1, right? We want this to maybe have $500,000 in cash to only $100,000 in liability. So anyway, I hope this helps you guys figure out what types of questions I'm going to ask, how I'm going to test you on this material, so that you're ready for the quiz and the exam coming up.